we'll talk about ETF strategies. I'm going to talk about two aspects. Firstly, they are strategic, and these are strategies that are used by institution, market exposure, directional view, core satellite, rebalancing, completion. Now, some of these terms kind of sounds a little bit alien, but not to worry. I'm going to illustrate using a case study in a short while, and you can see kind of how an institutional investor make use of some of this strategy, including market exposure, directional views, etc. It can also be used as an interim beta, cash management, derivative alternative, exposure management, and thematic. Now, these are all terms that are being used in the institutional space, but in the case study, I'm going to touch on a few of this to make clear some of this strategy that you just heard about. All right. So, main market participant that you must be aware of, as with any stocks and share or anyone that are familiar with the investment marketplace, in particular, the ETF space, we talk about the retail flow. Retail flow means, people like you and me, people who buy active funds, people who buy ETF. Now, we have the high frequency trader. We also have the advisor flow. Advisor flow are portfolio that are bought or assembled through an advisor. And of course, the arbitrage trader, which we look at in the early part of the lesson. And then, of course, institutional flow. These are the major market participants in the ETF ecosystem. Here is a chart based on a survey that was done in 2018. But I can tell you that the data is still very much relevant in today's context. Looking at it, a large majority use this in terms of tactical adjustment, core allocation, as well as international diversification. Things like, strategy like transition management, cash equitization are very little. And in fact, to put things in better perspective, I would like to kind of use this quote by Daniel Gambach from BlackRock. And he says that the majority of investors using ETF are doing active management. Only about 30% of ETF investors look at this as passive funds who are just there long term. Now, those are the minority. Most of the users are active users, not passive users. So a kind of buy and hold to the end represent not a big percentage. It does have its users that use ETF that way. But remember, I show you the major player involved in the whole ecosystem. I'm talking about majority are using it for active application, not simply a buy and hold for a long-term horizon. Okay, so I'm going to use example here, a case study that I'm going to introduce things like, interim beta strategy. And the whole idea about an interim beta is that the word beta in fund management context, when we say beta, we are referring to market. Interim market means what? Interim market exposure. So depending on the strategy, for example, in this case, I'm going to illustrate using a fixed income strategy. So this is a situation here that I'm talking about. Suppose you are a bond portfolio manager and you just receive a 200 million inflow with the mandate to invest into an Asia credit strategy. Now, you are not an ETF manager by any means, but you are an active Asian credit specialist. But then, in order to straight away implement this 200 million, it's a decent amount in the institutional space. The challenge is buying it straight away. And it takes time to source for this individual issue. Now, for a manager that's caught in such a situation, what he will do is to make use of an ETF to get an interim market exposure first, right? Which is why we use the term interim beta. An interim exposure, straight away you get exposed to it first. Why? Because you don't want to differ too much from the benchmark. Because if you take too long and the market moves, you could be very far away from the benchmark. Sometimes it's good, sometimes it's bad, but you are engaging in what is called career risk at stake. If you got it wrong, you didn't get exposed to the benchmark straight away, your client will blame you. All right, so what you do is straight away 200 million of the fund you purchase an ETF. Here it's called a IS Asia High Yield US Dollar ETF. And then you will do what is called a transitional arrangement. Now the whole idea is that eventually you will take your time to buy into individual issue which you have an expertise on. So the next chart will show you how this is done. You receive the money, straight away you buy. All right, you buy into this ticker symbol 09P, which is the Asia High Yield that I just talked about. After you bought the whole 200 million, after a certain period of time, this amount will change. The ETF holding goes down to 150 million. The individual square that you see in the chart here represent individual bond that you have bought. And then finally, by the time your final composition is done for your client, you are left with maybe just 30 million exposure in the ETF. The rest represent permanent holding in individual bonds that you have chosen, right? This strategy, the advantage is that while you are taking your time doing the research, now no doubt some portfolio manager has got a big team. They can have analysts supporting them, but still it takes time to assemble the right portfolio. And in the meantime, because of this instrument called the ETF, he can engage in an interim market exposure straight away. And this is highly efficient. And at the same time, in the final position, whenever there are some redemption requests, you can meet this redemption request without having to sell off individual issue, which, you know, at times, especially during volatile period, high yield bond funds may not be that liquid, but the ETF counterpart is a lot more liquid than the individual issue itself. And that allows you to build in this strategy to allow for redemption in the event that a redemption request happen. All right. Next, we're going to talk about liquidity sleeves. Again, one of those strategy that I mentioned earlier on. Again, the goal here is to reduce transaction costs and increase execution efficiency when implementing a tactical asset allocation. Tactical means that, you know, you have a view in a short-term time horizon. And if you use back the same example that we have earlier on, and, you know, imagine this money that you receive, 200 million, you receive it at a moment in time where you feel that markets are pretty volatile. For example, you know, a period such as what we are in right now. You could do one or two things. You could, you know, straight away buy into an ETF. All right, so that's called tactical asset allocation. One trade is done. Or you could be someone who say, oh, I want to individually buy every single issue. All right. Of course, no active manager would want to undertake this sort of career risk. Most of the time, you want to achieve efficiency first, in a very timely manner, and at the same time reduce transaction costs. So you want to very quickly assemble your portfolio as quickly as you can, right? In its original composition, that is what you want to do. And in order to achieve that, sometimes it's not easy. The very first thing you want to do is have what is termed as an ETF liquidity sleeves, right? You buy the ETF first, and slowly you offload piece by piece. All right, you layer on a different portfolio on top. And once you're confident you are able to switch into the relevant security that you are comfortable holding, then you will have your final portfolio. A little bit like the previous example, and in this case here, we're just simply talking about a very short-term basis, how you can make use of this to implement a liquidity sleeves. Now, many critics have come out and say that the next bubble is going to be created by ETF, right? But in 2020, round about March period, where we call this the COVID correction, ETF have proven the critics wrong, right? In fact, the last year or so, we see that, you know, time again, most of this article came out. I've taken both of this from the Financial Times as well as the Wall Street Journal, how they have passed the test efficiently.